The Capitol Creek's 3 in 10 podcast. Today is May 23rd, 2025. I am your host, Scott Slayton, Chief Strategist and Partner at Capitol Creek, a multiple family office in Austin, Texas, focused on the ultra high net worth category. Here are 3 things we think investors need to understand this week. First of all, the big, beautiful bill or reconciliation bill coming in at a whopping 1,100 pages. This is a complex piece of legislation. It narrowly passed the House by a single vote, 215 to 214. We think the key piece here of this legislation is the extension of the 2017 tax cuts. These were big and important tax cuts and were important in helping the economy grow well during Donald Trump's first administration. The CBO says that this big, beautiful bill is going to add around $3.77 trillion to the budget deficit over the next decade. We're also focused on how much growth is this going to add? Is this really stimulative at all? Or is it just really an exercise in extending what's already there? Well, we were able to dig and find that there's a state and local tax relief, otherwise known as SALT. There perhaps will be an exclusion of tips for taxation, and it does add another $150 billion to the defense budget. We add all that up, and it doesn't really move the needle that much on growth. There's not a lot of fiscal stimulus, new fiscal stimulus in this tax bill. Markets obviously are very focused on the budget deficit these days. And this big, beautiful bill arguably makes things worse for the deficit as we look out over the course of the remainder of this decade. In our opinion, there's been too much focus by the administration on the trade deficit and not enough focus on the budget deficit. And going back to very basic economics, if we can make progress on the budget deficit, then by definition, there will be progress made on the trade deficit because consumers will have less money to spend on imports. So we look at this big, beautiful bill, and we don't think it's so beautiful. And we're thinking that we're facing a long, hot budget summer ahead, where this is going to have to be taken up by the Senate and then sent back to the House. And if we were able to pass this by one vote, I think that the likelihood is that this bill is going to be less attractive to House members when it comes back from the Senate. Will it really be able to pass? It's probably going to be a white-knuckle exercise for several months here. And I'm not sure the markets are really going to like that. Number 2, the Chicago Fed's National Activity Index. This is a highly comprehensive gauge of activity and inflation in the U.S. economy. It consists of a weighted average of 85 different economic indicators across 4 categories: production and income, employment and hours, personal consumption and housing, and sales, orders, and inventories. The April data came in weaker than we expected at negative 0.25. That's down from a positive 0.03 in March. At 0, the index would be indicating that the economy is growing at trend. So the April data tells us the economy is back to growing below trend. And that's not such a surprise given the shocks that the economy endured in the months of March and April. So we're going to be watching this indicator closely in coming months as tariffs bleed their way into corporate profits, into corporate profit margins, into consumer prices, into consumer sentiment. And in studying this National Activity Index, when it's below 0.7, it's indicating a high likelihood that the economy is in recession. And we're a long way from that right now. But we're going to be watching it carefully because it's broadly based, it's well designed, and I think it's going to be a good indicator for us to watch during the summer. And number 3 for this week is the US dollar. The dollar today hit a new 18-month low, basis the Bloomberg Dollar Index and basis the Dixie Dollar Index, the DXY. So really no rally. In fact, lower lows since the trade pivot back on the 7th of April, which was such an important day for the stock market. Stock market went up 10% that day, I believe, and is up more than 20 percentage points since the lows of April 7th. So today we get more tariff saber rattling with this proposed 50% or threats of a 50% tariffs on European products. And what I would call kind of a bizarre 25% levy threatened on Apple unless they move production of the iPhone to the United States, which all of us know would take years to do and massive capital investment. And then the price of an iPhone might triple or quadruple. So this makes no economic sense. And then finally, we had the attacks on Harvard and the percentage of international students that are attending Harvard and trying to embargo them from having international students. Another bizarre policy move that we don't really understand. But taken together, those 3 things did not build confidence in the dollar. And they once again may have been a tarnishing element for U.S. soft power and a renewed proclivity for investors to want to exit U.S. assets at the margin. So we have said for a while in our monthly publications that we prefer precious metals. We prefer, in fiat currencies, especially favor the Japanese yen, which we see is massively undervalued relative to the dollar. Copper is another reasonable store of value with a very good underlying economic story over the next 5-10 years. And of course, Bitcoin, the number 1 leading cryptocurrency that cannot be printed. We see those as better stores of value. And if investors need more exposure to the equity or fixed income markets, we think fixed income products and equity products in non-US developed and emerging markets also make sense. So there you have it. There is your 3 in 10 podcast for May 23rd. We thank you for listening. Please check out our website at capitalcreekpartners.com to view our written work and our webinars. And until next week, be careful out there.